Good morning, and thank you for joining us this morning. My name is Orla Cousineau. I'm the Executive Director of Pensions for the Faculty Pension Plan, and I'd first like to acknowledge we are here on the traditional, ancestral, and unceded territories of the Musqueam peoples and the Silks Okanagan Nation. I'd like to welcome you all to our first virtual investment update. I want to just review a couple of housekeeping matters, which were on the opening slide if you joined the meeting early. If you can please use the chat function if you have any technical issues. But most importantly, on the bottom of your screen in the center, you'll see a question and answer icon. And if you could use that to type in your questions. And you can please submit your questions as throughout the presentation. We'll be monitoring them and gathering them together. So it's going to be a 30-minute presentation followed by 15 minutes of questions. This session, as we've already said, is being recorded. And the other thing we want to share with you is there will be a post-event survey. So we encourage you to fill that out so we get feedback on what you thought of the session. I'd now like to turn it over to Kamila Giesbrecht. She is the Executive Director of Investments. Thank you, Kamila.
Thank you, Orla. Welcome, everybody. Thank you for dialing in. We prepared this session in effort to bring you up to date and show you what we have done recently, tell you what we're doing on a regular basis, and we prepared a four-part of the agenda for today's event. I'll start with giving you an update on investment options, what changed during 2020. Then we will go through current focus of the work performed by the board and management. We'll talk about market environment and a few highlights from the performance. And as Orla mentioned, we'll leave some time at the end for questions. We'll be happy to answer them as we go through this. If I may, I will just dive into the presentation. The most important investment option in the center of our plan is balance fund. About 80% of all the funds you're saving for your retirement under umbrella of our plan is invested in this fund. So on the picture, you can see the composition of the balance fund. Global equity 30%, Canadian equity 15%, fixed income 40%, and there is a 15% allocation to real estate. And recently, we were focusing a bit on this portion of the portfolio. As you may recall, in 2019, there was a decision made to increase this part of the pie by 5%. And that came at a reduction from Canadian equity portion of the portfolio. Subsequently, a new manager was chosen for core US real estate mandate. The name of the manager is CBRE. The process of getting on board with such a manager takes some time. So during 2020, we negotiate contract with this manager, and we expecting first capital call in the first quarter of 2021. Another event, important event took place in 2020 around this portion of the portfolio. We were reviewing our overall allocation to real estate, and it was caused by one of our domestic managers changing slightly their current strategy and composition of their portfolio. We reviewed and conclusion was that this manager strategy is no longer appropriate fit for our portfolio. As a result, we found another manager. We redefined a mandate for this portion of the portfolio, and I'm happy to tell you that we are in the process of negotiating contract at the moment with the core global real estate manager. So the real estate will be 5% in Canada, 5% in US, and 5% global. There was a question before this presentation asking what's a difference between the balance fund and the new option fossil fuel-free fund. So before I move into giving you more details on the fossil fuel-free fund, I want to highlight that for each portion of the balanced portfolio, we have at least 3 strategies, underlying strategies, and at least 3 managers managing it. So balanced fund is diversified by asset classes, as you can see on the picture, but also underneath by having multiple managers and multiple strategies involved in managing this fund. And now we are on the fossil fuel-free bond and equity fund. And as you notice, there's a very precise naming of this fund. It says that it's bond and equity fund. And right there, there's a first big difference between this fund and the fund we were just looking at. This fund is composed of global equity, fixed income, and Canadian equity, 3 components. It does not include real estate. Also, entire portfolio is composed of 3 underlying fossil fuel-free funds, and all of those 3 funds are managed by 1 manager, Fraser. We added this new option on April 1st, 2020, and approximate size of assets at the moment is 48 million. We are quite pleased with that size. When we were starting, we were not sure how many members will actually decide to utilize this option, but it is growing. And with that growth, we expect that we will increase a diversification of this portfolio as much as possible. And in the future, it will be closer resembling how we're managing balanced portfolio. With the limited size, unfortunately, there are limited options what could be used to compose this portfolio. But as I said, going forward, we will be looking at maybe as early as next year, what else could be added to increase the level of diversification of this portfolio. And if we add real estate, we might need to change the name because no longer it will be bond and equity fund. Fossil fuel-free bond and equity fund is a special fund, and it was designed to enable investors to exclude investments in fossil fuel companies while investing in still diversified, actively managed, and quality-focused portfolio. But the focus is on a carbon footprint, and we are actually providing very detailed reporting, which I would like to point out is available to you. So you can see what's in your portfolio. And on this slide, I just chose one as an example. This is fossil fuel-free Canadian equity, so one of the subcomponents of the overall fund. So please look for those reports. They are available on our website and on Sun Life website for you. Natural question is, okay, well, if I'm thinking about choosing to invest some money in fossil fuel-free account, how our regular managers are doing? Are they focusing on providing at least some carbon emission reduction in their portfolio? And we have those conversations with our managers. All of our managers definitely incorporate ESG factors in their investment process. So it's important for them to do the right things for environment as well. And here I'm showing you Leif Wheeler, which is one of our Canadian equity managers. And this manager just started to report to us on their carbon footprint in the portfolio, and you can see a reduction when they compare themselves to a broad index. We will be working with our managers to provide something like this in the future for you. The other investment options didn't really see any changes in 2020. I listed them here just to kind of close out this part of the presentation. We call them single asset class funds. The only thing I want to remind everybody that Canadian equity, foreign equity, bond and bond fund are still having underlying strategies and different managers. And in the last part of the presentation, there will be an easy way of seeing all those managers involved in managing your portfolio. Now, the exciting part of the presentation. I'm sure you are wondering what's on our mind and what's focus of the board and management during current crisis and very different economic and market environment we are experiencing in 2020. Well, the short answer is we do everything we're supposed to do on an ongoing basis, and we follow our schedule of things which need to be done with certain frequency. But this year is special, and our project became more detailed and extended. I listed here what we've done to highlight the most important things. We do annual review of statement of investment policy and goals, but that document involves also the statement of investment objectives and beliefs. We hired outside counsel to make sure that we not missing anything and the changing environment is not causing certain aspects of how we manage and construct portfolio and how we formulate our beliefs if it's not influenced by what's happening outside. So we've done this. As I mentioned before, we reviewed very carefully real estate allocation this year. We are undergoing right now strategic asset allocation and portfolio construction review. That review was not scheduled to happen for another at least 2 years, but because of current dynamic changes in the environment, we brought this project to be performed a little quicker. And we will review all of the fund options as the last portion of this review. We're thinking about finding any potential places to improve our current portfolio, to make it more resilient and be prepared to crisis, hopefully not similar to what we are currently experiencing, but any potential economic surprises. We also have an ongoing dialogue with all the fund managers, and we perform regular rebalancing of multi-asset funds. And someone might ask why this is important. Well, this is important that we stay course, and when market environment is putting us out of alignment with our strategic asset allocation, we're going back there. It's also a way of taking profits off the table. If one component of the portfolio is outperforming the others, we're selling at a higher price and reinvesting in what's currently cheap. What we don't do, just as a reminder, we don't react to short-term news flows. We don't time the market. We here do not pick stocks and sectors. That is delegated to the outside managers. We don't perform any economic forecasting. However, we're very much aware of the environment and we monitor markets. We also don't provide personal investment or financial planning advice. And with that, I just want to highlight that whatever we do in the best interest of the members of the plan. Looking at membership as a group and trying to make it the best plan out there. We welcome your comments and we listen to your needs. adding this year fossil fuel-free option was definitely triggered by members wanting to have that option. So please do not hesitate to contact us. Obviously, we cannot accommodate the wish of everybody, but if there's a group of people looking for the same solutions, that will definitely put us in the right direction to make sure that we improving fund options accordingly. And now to the markets. Current markets definitely has challenges for investors. You all heard in the news, I'm sure, that we are at very, very low, potentially negative bond yields, that equity volatility is really elevated, that bond defaults are increasing, and they might still be going in that direction for quite some time. The GDP is contracting, and rising unemployment also will not surprise anybody. On top of that, or in combination with that, we have unprecedented government and central banks' response to crisis. The number of programs starting with asset purchasing to something which is not far away, and it really is a form of helicopter money where the stimulus package is supporting directly consumer, and there are money being issued directly to households. All this is creating a very new situation, and all of our managers are trying to cope with the environment the same as we do. That's why we are reviewing in detail if we can do something better. And our focus is on risk management, capital preservation, income generation, diversification, and also inflation protection. You might heard comments that inflation is no longer a foreign concept. For quite some time, nobody was talking about inflation, but in maybe not so distant future, we might need to deal with that. So with having all this in mind, we trying to provide the best options for you so you can save for your retirement appropriately. I thought I will show you some numbers. September is the last quarter reported. At the beginning of December, that might feel like a history, but I think 2020 is a special year, and it's still fresh in our minds what happened each quarter, with the big surprise of the first quarter and rather negative numbers in March, a fantastic bounce back in the second quarter where we were hearing some indices reached historical heights. And then we came to the third quarter when markets were still going rather optimistically up through the summer. And September came and muted some of those numbers and add some negative returns. We actually thought that that was healthy. That was a bit of the kind of sign that we stabilizing a little, and this big disconnect between current economic environment and markets being so positive was kind of coming back to the senses. But obviously a lot of things were going on and different forces working against each other. But September, I would say, was starting to kind of feel like a bit more, I'm afraid to say normal, but a bit more stable environment. It was almost welcome to see September being a bit reverting a bit what was happening in the summer. But when I look at those numbers, I want to mention that it's not a good idea to look at the numbers on a regular basis. And we do this for you. We know what's going on, but you're saving for your retirement, and you might make yourself really worry. So I want to show you, if you look at the year-to-date numbers at the end of September, where bonds were at 8%, Canadian equity 6.8 in Canadian dollars. When we flip on the next slide, I'm showing you October, which was rather negative month, and in certain parts of the market in a big way. And you can see that the year-to-date number is changing quite quickly from 8% to 7.2%, where year-to-date Canadian equity from minus 5.5 from previous slide to minus 8.7. S&P 500 representing US market in Canadian dollars dropping to 4%. So a lot of volatility, and we do not react to those numbers and don't want to adjust anything just based on that. What you could do, and I would encourage you to keep up with the market. We provide market commentary on our website. I'm writing that for you. So every quarter, and 2020 will show even from quarter to quarter how things are changing drastically. But you can find this information. I'm not going to read the slide, but those are just kind of a short comments. At the end, you can see quarter 4 entered twice. Well, we don't have quarter 4 yet. So just a taste of what's happening in October, and then November. November came, and November was largely positive. I looked at our unofficial numbers for all of our portfolios, and I can tell you that this is looking really good. If we could get a good December, we'll start seeing a huge improvement in the numbers we're looking at. But time will tell how this will turn out. So knowing what's happening at the market, giving you a bit of a taste of what we're doing, the final thought I have here is that you might be hearing that the economy is not the market, but we say that economy is where the corporate revenues and profits are coming from. We're paying attention to it. We want our managers to pay attention to that. In the overvalued market, which we absolutely believe that we are somewhere there, valuations are very high, extended. Market is very volatile. We truly believe that the main focus needs to be on risk control, and it's more important to control your risk than trying to add that additional potential return. And we believe that broad diversification and steady hand continue to be the best strategy. And although we don't provide any advice, I think that's the best advice we would be able to give to anybody. And now I would like to show you a bit of the performance, and there will be lots of numbers on the slides to come. But I want to give you a bit of a flavor of what we're looking at, what our reports look like. And it's not the only way we're looking at the performance, but it's just a sample. We'll go through this by dividing it into parts. We'll see fixed income first, then Canadian equity, foreign equity, real estate, and at the end, balanced fund and fossil fuel-free bond and equity fund. And right here, what's kind of first coming to mind is the heat map, which you can see. So we're looking at the numbers of this UBC bond fund. We can see right away how much assets we have. So 3.2% is sitting in this fund outside of the balance fund. And then we have performance numbers. The first number is a net number. So after all the cost, this is the performance of the fund. Then we have a gross number. Then we compare the performance against peers. So it shows us which quartile our performance is ranked in. Then we see the benchmark and differential, which is a value added, hopefully positive, between the performance of the fund and the benchmark. And the most important numbers, of course, are long-term numbers. And as you can see, we looked year by year to see what kind of pattern our funds are creating by the performance. And of course, this report is at the end of September 30th. This is just one point of time, but we do this on a regular basis. When you can see that for bonds, there's a lot of third and fourth quartile, a lot of orange and red. The only comment I will make right now is that not for all strategies, it's important to have green and yellow. For our active managers, of course, we want to be in that territory. But for our passive strategies, for example, not necessarily. We don't really expect that much for passive strategy. The passive strategy has one goal, and the goal is to mimic the market. And in this report, we start with overall bond fund, and then you can see underlying managers. You will see that AB Core Plus fund, which is AllianceBernstein fund, is having a lot of reds. That is one portion of the portfolio which did disappoint us in 2020, but for good reasons. So again, we review it carefully, and the manager was not doing anything terribly wrong. March really surprised them. And it was a very, very challenging time for active bond managers. Both of our active bond managers actually had a rather challenging time in March, but this particular one had harder time and did not have a chance to come back all the way after what we experienced in March. On the next page, it's PIMCO. This is our other Core Plus active manager. And here, very good news, a lot of green, first quartile performer. But I assure you, that was not the picture in March. And that just shows you that a very short period of time and drastic drop in the performance might change the numbers very, very much. So it's important not to overreact to short-term underperformance. And we are very, very pleased that this manager, subsequently to March crisis, came back and provided very good performance. On the next page, Canadian equity, a mix bag of colors, but mostly a pretty acceptable performance. And again, what I want to show here is that under the Canadian equity, then we have underlying managers, CCNL, Guardian. The fossil fuel free is not a portion of the Canadian equity. All the managers in alphabetical order. So this is cutting a little data. And you can see that fossil fuel free only has one full quarter. That might be a little confusing because the fund was added on April 1st. But it's actually missing one day for the second quarter. So formally, fossil fuel free just within the end of the third quarter finished the full quarter from the reporting perspective. On the next page, global equity. And again, the same thing. We have foreign equity fund and underlying managers. And the other thing which I want to remind you is that when you're looking at the balance fund, each component of the balance fund is managed by the same managers who are managing the individual asset class funds. So when you're looking here at the foreign equity managers and then underlying managers, this is how the foreign equity manager, global equity component of the balance fund is built. And again, fossil fuel free, it's getting in here with the 1 quarter performance, and one extra manager only shows on the next page, which is MFS Global Equity Manager. We are almost out of time, but I'm almost finished with the presentation. I just want to say a few things about real estate, which is a really great diversifying factor for our fund. And the managers, there's a bit of worry about how real estate is managing during the COVID and what will be aftermath for this part of investments. Our managers are doing pretty well. They have a quite high occupancy, and they're collecting rent slightly above 90%. For both of the managers, of course, retail is a challenging part of their portfolio, and that part of the portfolio is providing the downgrade of valuations of the portfolio at the moment. And here is the last slide for the performance balance fund, and then fossil fuel-free equity and bond fund. And as I said, balance fund is the focus of our attention, because 80%, and as of September, those 78.3% of all your money is invested in this fund. What we are very happy with here is that when you look at the 10-year number, the performance of the fund is sitting at a second quartile. There is a positive value added, and I wanted to point out that this positive value added is after all the cost. So it's a value added when we take into consideration the net number minus the benchmark. There is a value added. You could say this is small. Yes, it's much smaller in 2020 than we've seen in the past, but it's still good to see. And with improvement, hopefully of performance, we'll see other periods catching up and looking better. However, in summary, I must say that we do believe that future will be different than the past. We do believe that it will be difficult to repeat returns which we've seen for the last 10 years. And expecting that we will be performing 8% per year is probably not very realistic, at least until we get over the current crisis and we'll have a chance to recover. Our strategies did not completely disappoint us in 2020. As I said, we're reviewing them and trying to figure out if there's anything we can do to be more resilient if anything like this would repeat itself. But I think everybody would agree that COVID-19 surprised everybody, and not many were ready to weather this. So I think we did relatively well. And we need to keep in mind that the crisis is not over and there's more economic pain to come. And therefore, it's very important to focus on mitigating our risk and preserving your savings. And with that, thank you very much. I hope I gave you some ideas and highlights, and we'll turn over to get some questions.
Thank you, Kamila. Oh, that echoes there. I'm really sorry. I'm not sure how we can get rid of it. I'll try and make the questions short. First question, is the balanced fund still invested in fossil fuels?
Balance fund does not have any restrictions. Therefore, yes, it's a part of the portfolio will be very close to the index. I know that I was going through all this stuff very quickly, but we do have different strategies, and for some portions of the portfolio, when you have a passive strategy, then you're guaranteed to be investing in fossil fuel companies. And we also do not put any restrictions on our other managers.
Who's the manager of the fossil fuel free fund?
Jarislowski Fraser.
Okay. And why does the fossil fuel free option not have real estate?
It started as a small fund. It's growing, and there is more money coming into it. As I was mentioning, we are at 49 million. We will be looking at options this coming year if we can add it. But fossil fuel free will have two limitations. The fund which will be added will need to fit in the philosophy of allowing our members to invest in diversified portfolio without investing in fossil fuel companies, and it will be limited by the size. So it has to have a certain size before we can add certain type of products, and in the real estate area, that's challenging.
What does core mean in relation to real estate?
That's a very good question. Core real estate is the boring version of real estate investments. You buy buildings with one main goal: to collect rent, to generate income. So there is no speculation, no appetite for huge development projects. It's a kind of plain vanilla: buy the building, manage it well, and collect your rent. And that's what we focus on a very conservative approach in that part of the portfolio.
Kamila, there's a few questions where people are wondering what the size of the assets is in the various investment options. Specifically, how does the fossil fuel free fund compare with the balanced fund in terms of market value of assets?
So it's market value of assets is a huge difference between the between fossil fuel and we actually had them in the percentage right here on the slide. The first column right here, assets, this 1.9% next to fossil fuel free equity and bond fund. So from all the money invested in the pension plan, 1.9% is in, and that translates to 49 million as of September 30th. And right above the balance fund is 78.3% of the entire pension plan.
Actually, Kamila, I've got numbers in front of me, so I can quickly share it with the group. The fixed income, the bond fund, has just shy of 82 million. The balanced fund, just over 2 billion. The Canadian equity, 156 million, and foreign equity, almost 178 million. So that gives you a sense of magnitude between the different funds. Let's see. Sorry, I'll look up. Had a whole bunch of questions come in. Question around what the management expense, the MER, is on the balanced fund.
The balance fund is 44 basis points, so 0.44%.
Yeah. Okay. A question, why not capital growth instead of preservation, given we've been in an extended era of zero interest rates?
So I think that in current markets, the important thing is not to lose money. And why I say that? COVID accelerated certain trends, if you will, in economy, and created a lot of unknowns for us. We have really unprecedented participation in the markets from governments and central banks. The level of debt is growing exponentially. There are consequences to those things, and market is very disconnected from the underlying economy, and that's what I was trying to allude to the fact that market is not economy, but economy is at the end of the day where the profits for the companies and revenue is coming from. So we are cautious, and all of our managers are predicting that in the next 5 years, we should not be expecting the same level of growth. We should rather be prepared for low growth. There's also a question of potential inflation at some point. So, and if we get surprise of inflation, and I'm not saying we will, but if we will, then everybody is losing, and it's a matter of who is losing less. After all the research we've done so far, we actually think that if we get 4.5% returns for in near future, we should be happy because we are where we are today. And that's why we're thinking that we need to be conservative, and we always been conservative, but we need to be conservative, and we need to be prepared for that environment in which we need to operate.
The next question, why not permit us to manage our own money? Why not allow us unlimited fund options under the faculty plan?
Unlimited fund options. Sure. Unlimited fund options would mean, yeah, it would pretty much need to mean to give you the money and do whatever you want and not have the pension plan. So I'm not sure if that's an option. Adding more options is definitely an option. However, it comes with a cost. What we are able to achieve, the way we manage a pension plan currently, is a very attractive fees for very high quality managers. So if you would want to build a portfolio, you could participate in right now balance fund, for example. I don't think you will be able to do it at the price we are offering if you do it privately. I think that's the biggest thing we have. And there was another question also, why not more of the passive strategies to be available to the members? And that is something we're looking at closely. And important thing is that it has to be enough of an appetite to create a fund. Putting together fossil fuel free fund initially felt to us that from cost perspective it will be very difficult because if the size of the assets will be small, it would be very expensive for members. We managed to have a very good price, but a lot of things came to work in our effort. For example, for fossil fuel free fund, we combine our assets with other portfolios managed by the same manager. with endowment funds to get those fees down. So we spend a lot of time negotiating fees, and we have the advantage of pulling assets together. And the bigger the pot, the smaller the cost.
Next question, what happens when managers consistently underperform their peers?
So that's a very good question. The manager who is underperforming consistently goes to well, actually, it goes on an on-watch list very quickly, as soon as it meets one of the criteria of not providing performance at par to the peers and to the benchmarks. And if it stays on the on-watch list, we go through the formal review of such manager after 6 months. So this is monitored very closely. And we do have currently reviews of some of our managers under ongoing. So we just started, and we will be reviewing them very closely.
Okay, and our final question. Fund managers used to meet with the board in person at least once a year to make a presentation and answer questions. Presumably that's now done virtually. Has this compromised the ability of the board to manage the review process?
Correct. We still meet with the managers, and that dialogue was not broken. In this new virtual world, this is one thing which I don't think was impacted in any negative way. On contrary, it's just so easy to put on a computer and have a Zoom meeting with somebody that I would say that the contact with our manager is increasing, not decreasing. And the formal meetings with the board and board's meetings are conducted via Zoom, are not impacted in any negative way in terms of the dialogue with managers.
Okay, I want to thank everybody for joining us. We will be posting questions and answers on the website, and we'll send you a link so that the questions we didn't get to will answer through that means. As well, there will be a recording of this presentation available and posted on the website. Thank you very much. Have a good day.
Thank you.